Welcome to Focus on Alternatives, an educational series from ADISA, the Alternative and Direct Investment Securities Association. At ADISA, we're committed to providing insights and thought leadership on alternative investments. I'm Greg Mausz, I'm your host for today, and I'm pleased to be joined by Jimmy Atkinson. He is founder and CEO of OpportunityZones.com. Jimmy, I've been following your work in the Opportunity Zone sector for years. Thank you for all of the education and promotion that you do. Really appreciate it.
Well, thank you, Greg, and thanks for having me on today. Appreciate it.
Absolutely. Jimmy, for the financial advisors out there who haven't been thinking much about QOZs the last couple of years, what's today's headline?
Well, the big headline is, I like to describe Opportunity Zones, first of all, for those who are completely new, as possibly the greatest tax incentive ever invented. It essentially allows you to achieve unlimited tax-free growth as long as you have a 10-year hold within your Opportunity Zone investment. Great capital gains deferral mechanism, and then the back-end benefit after 10 years, exiting completely tax-free. It's hard to find anything else like that in the tax code. The problem with Opportunity Zones, one of the problems, is that when it was first enacted as part of the Tax Cuts and Jobs Act in 2017, it had a sunset date. December 31, 2026 was when the deferral period ended for investments.
We're here in 2026.
And now we're here in 2026. And so this could be a much different podcast episode that we're recording right now. We're talking about the end of the program. And in fact, yes, the first iteration of Opportunity Zones, sometimes colloquially termed OZ 1.0, is still sunsetting at the end of this year. But because of the One Big Beautiful Bill Act that was signed into law last July, the Opportunity Zone policy is now permanent. And so starting January 1, 2027, we begin the program all over again with a few new benefits. So the big headline is Opportunity Zones are not ending. They are now a permanent feature of the tax code, and there's some really cool stuff coming January 1, 2027.
Okay, so let's break that down further. First off, with QOZ 1.0, with that ending, what is expiring, and then what isn't?
Yeah, so if you already have an Opportunity Zone investment, if you made an investment in a qualified opportunity fund at any point in time from 2018 through the end of this year, you are an OZ 1.0 investor. And what that means is you deferred a capital gain, right, into a qualified opportunity fund. Your first benefit that you accrued when you made that happen is you get a deferral period. You don't have to pay taxes on that gain right away. That gain gets deferred until the end of 2026. Well, that's coming up right away. So that doesn't change. If you're an OZ 1.0 investor, you're still looking at that December 31, 2026 date as the date where you have to recognize that deferred gain payable. The liability on it is payable April 15th of 2027, essentially. So that hasn't changed. You may have also received, if you were an early investor, some basis step-up benefits, which will reduce your tax liability on that April 15th, 2027 date. But then things do start to change in 2027.
Okay. Is it still a good idea to do a QOZ investment here in 2026 with you having to pay your taxes basically just as if you didn't do it?
I think it is. I'm sure we'll talk about the OZ 2.0 benefits and what's changing in January in a moment. But at this point in time, suffice it to say, the benefits that are coming for next year and beyond are excellent benefits, and it is an improvement over the existing program. It's an improvement over somebody making an investment this year before we turn the calendar to 2027. That said, the majority of the tax benefit is tied to that 10-year hold, that 10-year benefit where you get to exclude appreciation of the OZ investment from income for the year in which you transact your OZ investment. That drives the vast majority of the tax benefit, and that's still available. That actually hasn't changed. Okay. So whether you make an investment this year or next year or any year in the future, that 10-year benefit is essentially the same, where if you defer an eligible gain into a qualified opportunity fund and you hold it for 10 years, you exit tax-free. Now, some of the details around some of the other benefits are changing.
So let's go ahead and go there.
Yeah.
So talk to us about what's new coming with 2.0.
So what's coming with 2.0 is, well, first of all, it's permanent now. So there's no more end date. And really, I like to, first of all, explain who gets which benefits. What is the dividing line? Am I in OZ 1.0 or am I in OZ 2.0? And really the demarcation line is December 31, 2026. If you make your investment up until and through that day, then you're an OZ 1.0 investor. If you make an investment beyond that date, starting January 1, 2027 or later, you get the OZ 2.0 benefits. The two major new benefits that kick in is one, you get a deferral period not to a specific date that's written into the statute, but rather it's a 5-year deferral. So if you make an investment January 2nd of 2027, you get to defer recognition of that gain until January 2nd of 2032. Liability due April 15th, 2033, effectively. The other thing that happens is you get a basis step up that effectively reduces the amount of gain that you then recognize on January 2nd of 2032. For most qualified opportunity funds that you invest in 2027 or beyond, you get a 10% basis step up. But Congress added a new wrinkle for rural opportunity zones. They want to see more rural development, more rural economic activity in the second iteration of this program. So if you make an investment into a qualified rural opportunity fund that holds most of its assets, in fact, it has to be at least 90% of its assets in rural areas, then you get a 30% basis step up. So I can walk you through an example of how it would work.
Yeah, and also define rural these days.
So rural is, there's actually, I think, over a dozen different definitions in the tax code and in different parts of the U.S. code, I should say. The USDA has a definition, the Census Bureau has a definition, and now this new definition in the OZ 2.0 legislation is effectively a brand new definition that doesn't really comport with the census map or anything, so it's a little bit messy. But what it essentially is it's an area that is not contained within a town or adjacent to an urbanized center with a population of 50,000 or more. So if you don't meet that definition, then you're rural. And if you just go to the Census Bureau and say you want to see rural census tracts, that might not actually fit the exact definition that Congress has laid out. So there are some maps available online that detail what is presumed to be rural. Novogradac has a great tool. The Economic Innovation Group has a great tool. I have a good tool at opportunityzones.com, which will show you which tracts we are assuming are going to be eligible and which ones we are assuming are going to meet rural status or non-rural status.
Okay. Now, you were going to give an example before I asked you that question.
Yes. So an example is, and I'll even put it to a particular date. Now, I'll walk through a few different scenarios, actually. Greg, what if you have a $1 million gain today? It's March 31st, 2026, the day we're recording this episode. What are your options? Well, typically you have to defer a capital gain that you trigger within a 180-day period. So what's 180 days from now? It's about toward the end of September, right, of 2026. So if you make that investment in a qualified opportunity fund, let's say mid-September of this year, you're an OZ 1.0 investor, because remember that demarcation line is December 31 of this year, so you're before that, so you get the OZ 1.0 benefits. So for you, you get a deferral period until December 31st, 2026, which is nominal. That's basically irrelevant because you're still claiming that gain on this year's taxes, so that's not that great. You also don't get a basis step-up because those basis step-up benefits expired years ago for this program. What you do get is you still get the 10-year benefits. If you hold your Opportunity Zone fund through mid-September or later of 2037, then you get to exit 100% tax-free. The other benefit that is sometimes a hidden benefit or the fourth benefit that doesn't get talked about as often as I think it should is if you're taking depreciation over the lifetime of that hold, particularly you might take a pretty sizable depreciation in year one with accelerated bonus depreciation back on the table now. Typically, in a non-OZ deal, when you sell it, you have to pay depreciation recapture penalty, or tax, essentially, usually 25% for a real estate deal. But because you held it within an OZ structure in the way that the OZ regulations are written, you escape depreciation recapture. So there's no depreciation recapture penalty you have to pay at all at exit. So it is truly 100% tax-free, and if you're taking depreciation along the way, you're also offsetting the cash flow over the lifetime of the hold. So that sounds pretty good, right?
Yes, it does.
That
I
already
didn't
sounds
realize
pretty
that
good.
Additional depreciation factor.
That's right. Now, let's change the facts a little bit, though. Let's assume that you triggered that gain today, but it's through a pass-through entity. Maybe a business that you are a partner in sold an asset. If there's some really particular rules about when your 180-day clock starts, if the gain gets reported to you on a Schedule K1, you have a few options. You can use the date that the gain was triggered, March 31, 2026, in our example. But you could also choose to elect to use the last date of the pass-through entity's tax year. Let's assume it's on a calendar year. So that would be December 31, 2026 is when your 180-day clock can start. You can also opt to use the due date of the pass-through entity's tax return as the start of your 180-day period. That's the third type of elections. That would mean typically for most pass-through entities that use a calendar year tax year, you're looking at March 15th, 2027 as the first day of your 180-day period to make your QOF investment. So then that does carry you into 2027. So let's assume that's the case now with that $1 million gain. Now it becomes interesting because you can make the election to start your 180-day clock, let's say December 31, 2026, and then you've identified a QOF investment you want to make, so you pull the trigger and make that investment January 15th, let's say, 2027. So what are the three benefits? Well, ordinarily, you would owe I'm going to assume a 23.8% tax rate. You'd owe $238,000 tax bill on April 15th of 2027. But because you deferred it within a 180-day period into a QOF, that gain gets deferred for tax purposes for 5 years. So now you're recognizing that gain January 2, 2032, and you would owe a tax bill on April 15th, 2033. But what's the amount you owe? Well, you get a 10% basis step up, remember. So the basis in your QOF goes up, and then the difference is a $900,000 essentially. It essentially allows you to reduce the amount of gain you recognize by 10% of your investment. So now you're recognizing a $900,000 gain on January 2, 2032. And so the tax bill is going to be, I can't do the math in my head, but it's going to be less than $238,000 due April 15th, 2033. And then the other benefits still remain. The 10-year benefit, as long as you hold that OZ investment through January 2nd of 2037 in our example, then you get to exit completely tax-free, and that depreciation, recapture, elimination is also still alive.
Thank you for walking us through all that. A lot of moving parts there. To simplify that, if you sell your business or your asset and you have that gain as of July 1st or sometime in July, then you really have the option to pick 2026 or 2027 because that's going to be your 6-month window, right?
Correct. So the date that would carry you into 2027 from this year is July 6, 2026, is the first date that technically you could trigger a gain outside of a pass-through entity, just individually accrue a gain. And technically that your 180th day would be January 1st, 2027. Now that doesn't really give you a lot of wiggle room. January 1st, the banks are closed. How do you wire money to a fund that day? There's some questions around that. So most of the accountants and tax attorneys and advisors that I talk to in the industry say, to be on the safe side, make sure you trigger your gain July 15th or later, if you have control over when to time your gains, and if making the OZ investment in 2027 to get these better tax benefits is meaningful to you. Try to wait until mid-July to make it. Otherwise, make sure that you're holding your assets in a pass-through entity, because then you can trigger a gain at any point in time in 2026. I'm sure there's people in this room right now who have clients who triggered gains back in January or February or earlier this month. And if they did so through a pass-through entity, they technically can wait until 2027, defer those gains into an OZ structure, and then get all the OZ 2.0 benefits.
Perfect. We were talking about maps a second ago. Bring me up to speed on the tracks. We have current OZ tracks. I hear that there's going to be new tracks, but walk us through that. And can OZ $2 be used on OZ1 tracks?
Man, that's the $1 million question.
Okay.
I'll cut to the chase, and I'll answer yes, probably, but with an asterisk, which I'll come back to in a minute, and remind me if I forget. But let's rewind and talk about how the tracks are currently designated and what is going to change starting next year. So Opportunity Zones were first enacted as part of the Tax Cuts and Jobs Act of 2017. And then in early 2018 is when the first Opportunity Zone designations were made. And the map was finalized early July of 2018 is when the Treasury published their final list. And so today we have 8,764 census tracts located all over the country. They're in every state in the country and the overseas territories as well. And that map remains in effect through December 31, 2028, not 2026. A lot of people assume because the deferral date is 2026, that's when the map ends. But no, the statute clearly says that the designations are good through the end of the year, 10 years after they were first designated. So that means December 31, 2028. So the interesting thing is we're going to go through that same process again starting in July of this year, just a few months from now. Every state in the country, plus Washington, D.C. and all the overseas territories, get to nominate up to 25% of their low-income census tracts to the Treasury Department for Opportunity Zone designation. And so that's a process that's going to play out over Q3 and Q4 of this year, and we'll get a final list and a map from the Treasury Department probably Q4 of this year, October-ish, maybe November, depending on how fast everybody moves. And that map will go into effect January 1 of 2027.
And is it still the governors choosing these locations?
It's the governors choosing the locations, yes, or somebody in their office, all right? But yeah, it is the governor of every state. It's the mayor of Washington, D.C., and it's the governor of all the inhabited territories as well, Puerto Rico being the biggest one. Now, what's interesting there is the current map doesn't expire until 2028, but the new map takes effect in 2027. So we're going to have a 2-year period where we essentially have two different sets of opportunity zones that are active. And one of the biggest questions that I've been getting for the last several months is if an investor triggers $1 million gain in March through a pass-through entity and then wants to defer it into a qualified opportunity fund in January of 2027 to get the OZ 2.0 tax benefits, can that fund then deploy into OZ 1.0 census tracts that may not have been redesignated under the OZ 2.0 map drawing? My answer and the consensus in the industry is yes, probably. There's nothing currently in the regulatory guidelines, the Treasury regulations, or the statute that expressly prohibit that. But I don't know if that was congressional intent to allow for OZ 2.0 dollars to kind of backfill these older OZ 1.0 tracts that in many cases may not be eligible anymore going forward. But I think they're probably going to allow for this. Now, we're still waiting on Treasury guidance. We're going to get some new regulations when Treasury publishes their list of eligible census tracts. There's some private groups in the industry, my group included, that has published our list of the census tracts that we think are going to be eligible based on recently released census data. But Treasury hasn't come out with the official list yet, and we're kind of waiting on them to come out with the official list and probably some other regulatory guidance about transitioning from OZ1 to OZ2. I'm hopeful that OZ 2.0 dollars will be able to help fund some OZ 1.0 tracks because there are still plenty of viable OZ 1.0 projects that are going to be raising capital, need some more dollars coming in over the next couple of years.
That's a lot going on, but I'm glad that there is a definitive, the Treasury is going to resolve these issues and people can act with clarity.
We hope, yes.
We hope. It needs to happen that way. Let's talk about advisors. What should advisors and sponsors be doing kind of right now?
Mm-hmm. So I'll talk about it from an advisor or investor point of view first, and then I'll shift to the sponsors. Advisors and their clients, they should really be thinking about this as an incredible tax vehicle for both deferring an existing capital gain, deferring future capital gains, but then also having that 10-year benefit. This structure is essentially a super Roth structure. You get to grow completely tax-free, unlimited amounts. So I think if you're an advisor, you should be keeping an eye on your clients when they're triggering gains, how big the gains are, and when they do have a sizable enough gain, consider talking with them about the Opportunity Zone tax benefits and, how an Opportunity Zone investment or how Opportunity Zone investments, plural, could fit into their overall portfolio. And I wouldn't even get too hung up necessarily on the timing. Well, first of all, if a client of yours has a gain from 2025, there's really no choice. They have to do an OZ 1.0 deal. There's no way to take a 2025 gain and put it into 2027. The 180-day period just doesn't work. But I would still say that's still a very valuable tax strategy to get that 10-year tax-free appreciation. Yeah, you don't get the deferral, or you don't get much of a deferral. Yeah, you don't get the basis step up. But at the end of the day, the bulk of the tax benefit really comes from that 10-year exclusion. Now, if you've got a client with a 2026 gain, or he or she is about to trigger a 2026 gain, think about how you want to time that, how you want to time the gain if you can control the timing. And if you can't control the timing, think about, well, how is that client holding that asset? Is there time to maybe transfer it into a pass-through entity so that we can have a little bit more flexibility when the 180-day clock starts, and possibly push the gain deferral into 2027 so we can get these added benefits, the 10% basis step up, 30% for rural, and the 5-year rolling deferral period. Okay, so that's some things for some advisors and their clients to be thinking about. On the sponsor side, sponsors are having a little bit of a tough time right now, I'll be honest with you, raising capital, because we're kind of in this, it's been termed a dead zone for capital raising, 2026, because the first two benefits are so nominal. The deferral is essentially non-existent. The basis step up literally doesn't exist anymore. There is no 10%. If you invest this year, you really only get the 10-year stuff. So it's harder for sponsors to market and sell the tax benefits of OZs today, when a savvy investor knows, well, there's some cool new stuff coming in 2027. I'm going to wait until then. But what sponsors should be doing right now is they should be gearing up for 2027. If you're a sponsor and you're going to have an opportunity zone offering or multiple opportunity zone offerings going forward in 2027 and beyond, start marketing those offerings now. Start talking about your strategy now. Don't wait until January 1, 2027 to start promoting this OZ 2.0 strategy. Start putting the word out there that you've got an investment strategy coming. You're going to be opening your fund on January 1, 2027, and here's what it's going to look like. Now, you won't have all the details filled in because we don't even have the map yet, but you probably have a pretty good idea, if you've been doing this for a few years, where the zones might be, what your strategy is. And so overall, my word of advice is don't wait. Start doing the marketing and the sales now.
I appreciate you walking us through that from the advisor and the sponsor perspective. Speaking of advice, what are some of the things that you've seen advisors or investors really do wrong that everybody should know so they can avoid making those mistakes?
Well, probably the simplest dumb thing that I've seen investors or advisors do wrong is blow through the 180-day period. It's pretty much impossible to cure that once you've missed your 180-day deadline. It's pretty clear-cut. Now, again, if your gain's coming through a pass-through entity, you've got some flexibility there, so it's a little bit easier. One kind of tricky thing with the pass-through entity is that there's actually a little bit of a dead period. In fact, in the example I gave, let's revisit that. $1 million gain through a pass-through entity that we trigger today, March 31. So if you opt for window A, which is March 31 is day one of your 180-day period, that takes you up through roughly toward the end of September of this year. But then window B doesn't open until December 31 of this year. So one mistake that I sometimes see is somebody will try to defer that gain in October or November or December of this year. And you actually can't do that because it doesn't actually line up with any of the windows. I mean, once you miss window A, you have to wait a few months for window B to open. That one I've seen a few times as well. And then just simple stuff like not consulting with a CPA. You want to make sure that your CPA knows what you're doing because the tax benefit doesn't accrue automatically. You do have to report it as an investor. You have to report it with Form 8997 every single year that you hold it. And then the other one is chasing after the tax benefit without underwriting the investment opportunity. So the tax benefit only accrues on profits. And if there are no profits, there's no tax benefit. So make sure that the underlying deal is good. Because if the underlying deal is bad, even if the tax benefit's amazing because it's an OZ, it doesn't matter. So those are a few red flags I'd watch out for as an investor.
And are you seeing most investors being able to get the liquidity that they need from one source or another to meet their tax obligation?
That's a great question. And the answer is, I don't know, because nobody's had to do it yet. Because the deferral date for everybody in OZ 1.0 is December 31, 2026. The liability is due in April. So I'd love for you to ask me that question a year from now, because I think that is a concern. A lot of funds, when they first started marketing and raising capital for their Opportunity Zone offerings back in 2018, 2019, 2020, they were underwriting with certain assumptions about how they would be able to do a cash out refi in 2025 or 2026 at certain rates, and they'd be able to return some liquidity to their investors. So the investors would have some liquidity to pay that deferred gain liability due April of 2027. Well, then interest rates went way up and the economy turned kind of sideways. We had COVID, construction slowed, and a lot of these projects aren't where they had assumed they would be when they first opened. And I do wonder if that's going to cause somewhat of a problem in late 2026, early 2027, when the investors suddenly realize, I got to scrap together enough cash to pay this big deferred tax bill. I would say if you're an investor or you're an advisor advising clients who are interested in OZ investing, you should do a suitability analysis. And something that I like to consider is, and I always caution investors of this is illiquid alternative investment vehicle. You're not going to be able to get your cash back right away, particularly with an Opportunity Zone real estate investment. These almost always have to be ground up development deals or substantial improvement of an existing asset. And I'm not talking about a fresh coat of paint. I'm talking about doubling the basis in the asset. So these are the types of projects that do carry a lot of risk and don't have a lot of cash flow in the first several years. There are some exceptions to that. There's some other asset classes that offer some cash flow more immediately. There are some ways to acquire an already built real estate asset if you can do so pre-certificate of occupancy. You can speed up the cash flow a little bit, but most of what's being offered out there is ground up development. So, what type of investor is suitable for an Opportunity Zone offering? Well, it's somebody with a significant net worth, already has their main asset allocation kind of taken care of, and they want to diversify a little bit into some alternatives. And then they can afford to be in an illiquid asset or have at least some of their net worth in an illiquid asset for at least 10 years if they want the full tax benefit. And they shouldn't rely on the fund necessarily being able to help them out with the liquidity so that they can pay their tax bill 5 years later, or in 2026 if they're an OZ1 investor. That would be a great to have. And oftentimes I think that will be available to them, where there may be a cash out refi, or the cash flow from the investment will be enough to cover that liability at some point in the future. But I wouldn't assume that. Assume the worst. Make sure you've got a little bit of dry powder on the side in the event that the fund doesn't perform the way you're expecting it to, and you're still going to owe that tax liability one way or another.
They're always going to get their taxes.
Exactly.
So as we wind down here, any final practical advice for the ADISA audience? I know we've covered a lot of ground.
I think the practical advice is, if you remember nothing else about this podcast, I know we covered a lot of ground. Remember this, the thing I led with at the beginning. I think this is the greatest tax incentive ever created. It's not for everybody. Again, think about that suitability analysis you have to perform for your clients, or if you are an investor, for yourself. But it is an unbelievable way of achieving tax-free growth if you can withstand the 10-year holding period, if you don't mind some illiquidity in your portfolio, and if you want to make an impact in America's growth markets, these areas that are low income but can turn around with help from this program.
Jimmy, that is a great summary. Thank you for sharing all of your advice on everything Opportunity Zones right now so that we know how to prepare for what's coming.
You bet. It was a pleasure.
And thank you for listening to another episode of Focus on Alternatives. For more resources and information about alternative investments, please visit adisa.org. Stay tuned for our next episode coming soon, and don't forget to like, share, and subscribe to the ADISA YouTube channel.